Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
So there we are, driving down the highway in Alaska, mountains on the right, open road straight ahead of us, driving towards the coast. And I see this parking lot, and it's just packed full of camper trailers. So, we've been having all kinds of supply chain issues throughout the world, but Alaska has its own supply chain problems, right? Driving around, seeing these just complete yards full of huge, heavy, old equipment, right? It's saying, why isn't somebody taking that and getting it scrapped? Like, that's a lot of money that someone could make, but they have to barge it, put it on a boat and take it to Washington in order to recycle it. So they have their own supply issues. So seeing this trailer, this parking lot full of camper trailers, just wondering what in the world is going on. So I asked my friend who lives there, what is going on with this just parking lot full of brand new camper trailers? And he says to me, those came around the end of 2020, beginning of 2021, and they've just been sitting there. They bought all these things because they thought they were going to need them, and they were planning ahead because the supply chains are so difficult to get stuff there, and nobody's buying them. They're just sitting there. And think about the amount of capital that's tied up in a parking lot full of brand new camper trailers. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is your retirement recession-proof? Well, Daniel, that looks, a parking lot full of and usually they rent those parking lots because their lot where the dealership is so full already. They need a place to put the extras. And so there's a lot of product there. But evidently, if they came in almost a year ago, they've been there for almost a year, they're not moving. So where's the demand? Looks to me that that's a sign of a recession. And it's kind of interesting, right? Because, depends who you talk to. We're big here about as far as definitions go and words that you use and what you mean by those words. And real interesting because the technical people, right, Daniel, they say, yes, we're in a recession because of the definition of a recession. But the White House, on the other hand, is saying, no, we're not in a recession, right? So first, we have to find out, are we in a recession? Are we not in a recession? Or is recession coming to make sure that people's retirement plans are recession-proof for whether we're in or it's coming? So, what's the technical definition of, a recession, Daniel?
2 consecutive quarters of declining GDP. So gross domestic product, right? And so we've had 2 consecutive quarters of declining GDP. Some of the other leading indicators or things people look for would be an inverted yield curve. So if you lend your money, you would expect to earn more the longer you lend your money out, right? So if
a 5-year CD over a 1-year CD.
Right? If you were going to lend me money for 10 years, you'd want a larger amount of interest than if you lend me money for, let's say, 2 years or 1 year, right?
Or 6 months or whatever.
Or 6 months. And so what happened was the curve inverted. So you could earn more money on a 2-year treasury than you could on a 10-year treasury.
Crazy.
And so that predicts a recession because basically what the market is saying is we expect the future to have worse, the economy to be worse than the present, right? And that's why that does it. It's predicting the future. The other thing is
we see that happening a lot, don't we, with all these rates? Yeah.
The other one is consumer confidence, right? Mm-hmm. And so consumer confidence has set an all-time record of a low. And so we have the technicals saying, this is a recession. The definition of recession has been met. People's confidence, those RVs are there in that parking lot, right? Because people don't have confidence that the future is going to be good for them to afford the payment on those camper trailers. Yeah, there's tons of people that still want to camp and have a good time, but maybe they're worried that they're going to lose their job. They're not spending as much, right?
Or
And that's
or the interest rate is higher, right?
yeah,
a lot
that's a
of
big
times when
part
they
as
buy
well.
those, they don't have the money. They're buying it over time, and if the interest rate is higher, they can't afford it now. Where maybe back a year ago they could have got that for $400 or $500 a month payment. That might be, especially for Alaska people, affordable. But now maybe it's pushing $1,000 a month, right? Potentially. So good.
Yeah.
And the one thing, Daniel, for those in our listening audience that are not clear on GDP, right? Gross domestic product. Help us understand that. I mean, isn't that like, everything that's produced in this country, the value of what's produced? Is that what that exactly is? Or explain to that in a way that people can understand?
Yeah. It'd be like if you added up all the earnings that were created in the United States, right? And then basically that would be what the government would get. That's how they get their tax receipts, right? Based on all earnings, all earnings in the US. And it's a way of measuring how prosperous a country is. Right now the US has the highest, the largest number GDP out of any country. Now, some people think China's going to catch up and surpass us, but right now and for a long time, the US has had the most gross domestic product. So they're producing the most things, they're creating the most wealth out of any country. And that's a way of measuring how good the whole of the country is. To put it in perspective, California is the 5th largest economy in the world by GDP. So just one of our states is that big compared to the whole of the US. It's pretty big.
Wow. Okay. So thank you for that. Well, if you just picked up listening to us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is your retirement recession-proof? Well, we want to be able to help educate you on that. And with that, some of the things, we're giving away a paper today that can help you understand some things that you need to do in order to prepare and be ready for recession. As we go in today's show, we're going to be talking about what is a recession, and then how to be what's the best way to have your investments and retirement set up for that, obviously. But we'd like to give you this white paper. It's called The Importance of Financial Defense. So call 800-725 if you want that, 800-725-7616, and ask for financial defense, and we'll be glad to get that out to you. No obligation. So Daniel, as we're talking about this, one of the things that is so interesting to me is what you had brought up when we were talking about the show, and how way back what things were called way back in yesteryear, and then moving up closer, and then they changed the name again, and then they now it's probably going to change the name again because the White House wants to this is the way that they can control things, by changing the names on things to make people again talking about definitions, words and definitions, right? So you want to run through that a little bit?
Well, some people may not agree with this because they say, a depression is different than a recession. But the way they used to term these things while they were happening was, in the 1800s and such, it was called a panic, right? There was a panic where people would freak out. Banks were failing, things like that. And people would freak out. They were trying to get the money. They were panicking, and the stock market crashes. We go into what we call now a recession, right? But they called it a panic. And then we moved on and they started calling them depressions, because panic, it had bad
connotation, right? I mean,
connotation, right?
If you say, hey, we're in a panic, then that's going to make everybody panic, and they don't want people to panic. So then they let's call this depression. And people may not, right? It's not so bad. It's just depression.
No,
right?
It's just a depression. And then that got bad real fast because of the Great Depression, right? And so then they started calling these things recessions.
And there's a reason they call it Great Depression. So now they call it in recession, right? Okay.
And if you look it up, people might say, well, no, a depression lasts far longer than a recession. But the great financial recession, right? The GFC, that was pretty bad connotation. And we call it recession because that was people don't want to think as a depression. So it's a softer word. And then I forget somewhere along the way, I forget what administration it was. They were saying, you can go out there to the Treasury Secretary, you can say anything, but don't call it a recession. And so he was calling it a banana, like a banana. And I forget who that was. It was hilarious. But now the White House won't admit that we're not in a recession. So like you said, maybe they'll change the name to something like, a dip or something like that. I don't know, a slowdown, the next word will be a slowdown. I don't know, but it's just funny how we change those because of those connotations, like you were mentioning. It's a negative connotation. So the question is, are we in a recession or not?
Well, that's a great question. I was, we have an RV that we do business in and go about the country and see our kids and all kinds of stuff. Enjoy that. Well, from our last trip, we took it in, and I was picking it up the other day, and the owner of the place came out and said, "Hey, Andrew, we're in a recession right now. We got some issues going on." I said, "Why do you say that?" And he said, "Well, number one, this one RV manufacturer has closed 2 plants." Now we're talking about, like a year ago, you couldn't get RVs very, very fast. You'd have to wait 6 months to get your RV that usually was just sitting on the lot. Well, now he's saying they're closing 2 plants. Why are they closing 2 plants? Because, why do you close a plant? Because it doesn't have, either you don't have the workers that you need, or, but ultimately it would be because they're not having the business that you need. Then he said also there's a very big name dealership that's cutting their product by 45%, the price of their product by 45%, because they see it coming and they don't want to get caught with their pants down, kind of thing. And so, that's another indicator. Plus, we'll look at the price of gas. Well, somebody said, "Hey, I saved 10 cents a gallon on gas." You didn't save any money on gas. It went from $4.80 a gallon to $4.70 a gallon. It's still, more than 100% more than it was, a year and a half ago or whatever, right? That's, thinking that you're saving money on the gas, that's crazy. But anyway, this is not, the times that we're in are tumultuous times, and there is good news coming. There's good news coming. So you're going to want to, continue. If you're in our listening audience, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what they don't know. So we're trying to educate you, help you to understand. And with that, you want to stay tuned for hearing the good news that's coming with this. But we have a book before we take a break we want to give out called The Most Important Thing by Howard Marks. And this is a book that we've given out before. This is a book that's talking about philosophy and strategies for how you can prepare to be able to not run out of money and to be able to have what you need the rest of your life if you follow some of Howard Marks's thoughts and philosophy, as he's, Daniel, been a hedge fund manager for many decades, right? Do I have that right?
Portfolio manager, and I think this is his 5th decade that they've been in business. So they've been through many market cycles. He understands market cycles, as it says, common sense, right? It's common sense strategies. And anyone that wants to protect themselves could, or just wants to learn more about structure of markets and how to take care of their families, can learn a lot by going through that book.
Excellent. So we'd like to give this to you for free. Just call us at 800-725-7616. We put that in your hand. 800-725-7616 for the next 5 callers. All right. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, Daniel, many times, we're doing reviews with people as we typically do on a regular basis. And now when people are coming in, they're asking me two questions. Andrew, I want to know two things. How is my money in regard to the stock market right now? Our stock market is down 15% or thereabouts and in that vicinity. And how's my money? Am I down that much or what? Secondarily, how am I poised for inflation? And I say to them, hey, this is great news. I love having these conversations with you today because, many people in my profession, I think, are not so inclined to doing this because their portfolios are down. Well, in your portfolio, you're down maybe 2 or 3% when the market's down 15%. So that's hardly anything. But we're not as concerned about the value of your portfolio as what that portfolio can do, because you're not going to spend that $1 million, $2 million, whatever it may be. You need income off of that, a check off of that. And your check off of that, is producing $100,000 a year. Well, it's up to $110,000, $115,000 a year. And that is huge. And that's staying up with inflation. But the biggest thing is, why are they asking me about staying up with inflation when that wasn't a question a year or 2 or 3 or 4 or 5 years ago? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, is your retirement recession-proof? And Dad, there's two things that really stick out there in that. Number one is, usually when people start asking about the inflation question, we're at the end of it, right? Usually when people start coming and asking about these things, it's about to end. When people want to jump into the market, aggressively, when everyone's talking about Tesla stock or this or that, usually that means we're towards the end of it, not the beginning.
Right.
So, possibly we're coming towards the end of at least these major increases in inflation. And there's good arguments on both sides, right? There's really good arguments on both sides. There's really good arguments on both sides if we're in this recession. But if people have loss of confidence and their money's not going as far, right? If their food, because food, shelter, and energy have gone up tremendously. Yeah. And those are things you have to pay. So what does that mean? You have less money to spend on the other things like RVs or second houses or boats, right? Or travel, these kinds of things. And so we're starting to see that with the earnings calls that have been coming out. Starbucks says everything's fine. We're not seeing anybody trade down. That's what people usually do, right? In a recession, is they trade down instead of buying, top steak, top cut steaks and things like that. They buy hamburger, right? Or chicken. Instead of buying, premium brands, they trade down to a lesser brand. So Starbucks says they don't see any difference, but places like Walmart and McDonald's and other companies are saying they are seeing people trade down. So again, you see this like, are we or are we not? There's good arguments on both sides.
Oh man. So, then, where does the inflation versus deflation argument come into play and debate come into play? Because that would seem I'm thinking it's the same thing. As you got good, questions, good stances on both sides on that standpoint. Is that right?
Yeah, it is. And it depends what you call inflation. I don't think it's really inflation. I think it's the value of the currency, right? So houses went up by 40%. Gold went up by about 40%. Well, what did we do to the money supply? We increased it basically by 40%. So it's really basically the same, right?
Right. There's no increases. It's just trading, one for another. Apples for oranges.
But what the Federal Reserve is doing is they're saying, hey, we want to slow this down. And so if you take interest rates from 2.5% to 3% up to like 6.1, I think they are now on housing.
Right.
What do you think that's going to do to housing values?
It should bring them down because people.
It's going to deflate them most likely, right? It's going to deflate them.
Right.
Right. So these are the kinds of things. If the Federal Reserve says we're not going to make money, money's not going to be as loose. What is that going to do to your stock portfolio? It's going to deflate it, right?
Okay.
Because people will have other options instead of going and buying a stock where they can expect realistically, 6% returns a year.
Yeah.
Maybe 7% realistically a year before the Fed did that.
Yeah.
Then now they can buy a treasury for 3 or 4%. You got a 2% spread from going something that's risky to something that's safe. A lot of people are going to take that. And if it's not US investors, it will be
outside the country,
outside wealth funds and other countries and things like that do it. Right.
Right.
So these are all deflationary. Basically, the Federal Reserve is saying we want to slow down demand.
Right.
So that we want to deflate these things so people stop spending as much and we can bring inflation down.
Okay. All right. Well, if you just joined us or if you've been listening, you listen to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. Today's topic is your retirement recession-proof? Well, we have a paper that we'd love to be able to give you to help you recession-proof your retirement. It's called The Importance of Financial Defense. So if you can ask for it by name by calling us at 800-725-7616 and ask for financial defense. And we'd be glad to get that out. No obligation, free of charge, so that you can educate yourself and know what you don't know so that you can make an informed, smart, wise decision. Daniel, protecting somebody's retirement from recession is a very important thing. We've seen all kinds of different things happening, and sometimes, there's problems, there's short-term problems, there's long-term problems, there's investments that can be valuable to people in recession when, typically people are thinking, anything that's happening, the stock market is the answer. Let's buy stocks, stock market is the answer. But you and I both understand that the stock market is not the answer. It may be part of the answer, possibly, but it's not the answer. What do you have to say to that?
Well, going back to your story about people asking about inflation and how it's affecting them, we didn't get to the part where you said that their spendable income, right, their retirement paycheck is up. So that doesn't happen. You don't get that up because people are talking about inflation, right? You got to work on that a couple of years before, seeing what's going on in the economy and start getting that. So it's not like a flip you can switch on that just says, hey, we're going to increase this. It's something that works over time that you're planning towards. And so when we say, are we in inflation? Exactly. Or aren't we in it? Are we in recession or are we not in recession? I say, if your portfolio is set up properly, why does it matter?
Right.
Right.
And that's the key.
If it's recession proof, what does it matter? Because you win either way. Right.
Right. Okay.
If we're not, assets continue to go up, and your portfolio goes up. If we are in and we have this deflation we're talking about, we have asset price deflation, we have housing deflation.
Right.
Your income is up because it's been continuing to compound and grow, right? Which allows you to take that income and buy assets on the cheap, which then increases your cash flow, increases your income, increases your spending ability. So now you have even more and you get to choose if you want to increase your lifestyle or you want to keep buying assets on the cheap, buying investments on the cheap. Yeah.
Nice. I like sales, and that's what's going on right now, right? We're buying investments on sale right at the moment for some people, but that's not how they get the double-digit increases. It's because we bought them on sale in the past too. But the good news is, for our clients at least, is that, going into the future, because we're buying these things right, it's going to help them continue to do that. So that's great. If the investments are set up and allocated properly, that's a great aspect to be able to put you in the driver's seat, for a recession, as opposed to, oh, woe is me, and just happen, and whatever happens to me, and kind of like more of a leader rather than a follower.
Right. And that's where that diversification of income streams and diversification of assets comes in, right? Because when you're talking about how is somebody only down a couple of percent when markets are down, depending which index you look at, right? We'll say 15%, but I think the NASDAQ is still around 20%, right?
Okay.
When we look at that, how is that possible? Well, it's the diversification. These big indexes are no longer diversified. It's just a lot of stock. So if you look at like energy, for example, it represents, I think, 3%. It might not even be that large of the entire S&P 500. That's a whole asset class. Like that's not, so energy has done phenomenal. But if you only have 3% in your S&P portfolio, that's not going to make a dent, right?
Right.
Or what about non-US denominated assets, right?
Right.
So right now the dollar is strong, so those are not doing as well, but that presents a buying opportunity. And then when we flip around and the dollar is not doing as well as these other ones, these will be up high, and you have you got in lower, you'll have the choice. Do I want to sell out and go back into some of these US denominated things so that I can participate in a lower thing? Or do I want to just keep collecting my income, and it's a larger income because it gives you more purchasing power in the dollar? So it's not like half of your portfolio is that way. It's little sections that are true diversification through asset classes and different types of income streams to protect your purchasing power. That's what we're talking about when we're talking about, does it really matter if we're in recession or not when you have a recession-proof retirement portfolio?
Yeah. The true diversification is a very important piece of that whole thing. And, that's a whole nother thing we're going to have to talk about when we come back from break, as well as allocations, we'll talk about when we come back to break. But in the meantime, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is your retirement recession-proof? We like to give you this book to help you recession-proof your retirement. It's called The Most Important Thing by Howard Marks. It's got a lot of strategies, a lot of ideas, a lot of things that he has done in his multiple decades of investing monies that makes sense. Like, one of my favorite things in here is how he talks about the 6-foot tall man that drowned in 4 foot on average water. Well, how did that happen? Love to give you this book so you can find out about that. 800-725-7616, no obligation. 800-725-7616 for the next 5 callers. Call now. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com.
Dad, there's this thing we call treasure hunting, right? And an example would be, I was talking to this guy selling some trucks, and he told me, there's a dealership right over there, and they had all these brand new Jeeps. And so what I did was, when no one could find a car, I went over to that dealership and I bought all their brand new vehicles, brought them over to my used lot and sold them for more money. I was like, you really did that? And he was like, yeah, I sure did. And then I was thinking about it. And if you went, you bought one of the Broncos, right? Yeah, you went, you bought a Bronco for $55,000, $60,000. People did that, didn't use them, and now they're selling them from $85,000 to $90,000. Right. So these people, they treasure hunted. They realized that they could buy these things, and then sell it for a 30% profit or you know, a $30,000, $20,000 profit. That's what
like 50%-ish. Yeah. A lot of money.
Just right off the bat, or like the Ford Lightning right now, right? You can't even buy one. So people are selling these things. You could buy it for like $69,000, $70,000, but you can't buy one. But the people who have them are selling them for like $140,000. If you go look them up, they're between $120,000 and $140,000 for these things. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Glad you tuned in. Today's topic is your retirement recession-proof? And we're answering the question today, you know, are we in a recession or not? And does it matter if your portfolio and retirement is recession-proof? Daniel, that is really crazy how that happens, right? You know, and I understand that. That's why, you know, you and I both went out and we ordered Broncos, so we could just pay the sticker price instead of having to get it jumped up, right? But you know, that is crazy, and the price goes up, and when people are still willing to pay it, you know, you have to wonder where is this stuff going to stop? Is it going to stop? You know, how do you position yourself for when it stops? Like we talked about in one of the, you know, at the top of the show, that parking lot filled with RVs, that the RV dealer has all these things on their books, financially speaking, and are they actually going to be able to sell them? And it doesn't look like it, because they've been there close to a year. So just crazy stuff's happening, right? And
yeah,
how's that?
So paint this picture, right? That's a speculation, right? You can hope that you can buy that Bronco for, let's say, $55,000 and then go sell it for $80,000, right?
Right.
And as long as times are good, people can get credit, people have confidence in the economy, that strategy can work.
Right.
But if it doesn't, and people will only pay, or the supply chain issues go away and people can go to the dealer and buy it for $55,000,
right,
then why would they buy it from you for $80,000, right?
Right. Reminds me,
returns are made up of two things, right? Income and growth. So that's all growth. That's a speculation. So TR, your total return, is made up of two things: income and growth. So let's make up everyone understands that scenario where you buy this for $55,000, this Bronco, anticipating you can get $80,000 for it. Okay. So you've got it on order. It comes in, and that's speculation. We talk about it. The definition of investment is it pays you.
Right.
So it's not paying you anything, but you're hoping that you will be able to flip it for more. Okay. And if you do, that's a very nice profit.
Right.
Let's make up the scenario
high risk,
where
high return, high risk.
Yeah, that's a lot of capital you have to come up with, right, in order to earn that. But if you can, good. So let's make up a new scenario. Let's make up the scenario that when you buy this Bronco, the dealership says, we will pay you, you know, to show off this Bronco, contractual, we're going to pay you $15,000 a year.
Yeah.
And we will buy it back from you in 4 years for the same price, for $55,000. Okay.
Yeah.
So now you know that you can make $15,000.
And that's in a contract. That's a signed contract.
It's a signed contract. And in 4 years, right?
Yep.
They'll buy it back from you. Now,
nice.
That sounds good. But what if you were out treasure hunting and you found that same Bronco from the same dealership with the same contract, but you could buy it for $50,000 instead of $55,000?
10% less. Nice.
So you're buying it at a discount.
Yep.
So you know you're going to earn $5,000 on the Bronco when the dealership buys it back from you.
Yeah.
And you know that each year you're going to earn $15,000. Now, these are all made up numbers, but this is the kind of thing that we're talking about when we're talking about looking for deals in recessions or just mispriced price securities. Instead of the speculation, I want to buy Tesla and hope that it goes up, right? We're talking about buying things like corporate bonds, good, strong companies, right?
Contractual.
That have contracts that say we are going to pay you this much each year, and we will buy it back from you for par. So, in that scenario, we will buy it back from you for $55,000, right? You get your interest, they buy it back from you. Those are kinds of deals that are available. And when you're positioned properly, you can ladder them in a way that you always have cash coming due. You always have cash flows coming in. And so when we talk about going into recessionary type scenarios, you're the guy that has cash. You're the gal that has cash to take advantage of the opportunities that present themselves while still earning an income stream that you can support the lifestyle that you want to have.
Wow. That is wonderful. The way to recession proof your retirement. So financial strategies with Andrew and Daniel Agemy is what you're listening to. Today's topic is your retirement recession proof? And we're glad to have you with us today because people don't know what people don't know. And we want you to be able to make a wise, smart decision. So to know some of these things. So we're giving away paper to help you understand this aspect of allocation and allocating your money differently than just the HOPE model. And what we have is, we have two different papers on allocations. One's are your allocations right for RMDs, and the other one is are your allocations right for Social Security? Similar but different. Talking about allocating your money properly so that you can be prepared if we're in a recession or not in a recession. You can have those papers for free by calling us at 800-725-7616. Just ask for the papers on allocations. 800-725-7616, or check us out on the web at agemy.com, agemy.com, and you can contact us through that as well. Daniel, that's a great scenario what you're talking about in regard to buying that Bronco, that $55,000 Bronco on discount for $50,000. 4 years later, getting $55,000 for it and making $15,000 every year that they're going to pay you for showing off the Bronco. You're making more money in the $15,000 over the 4 years. That's $60,000 you're making over that period of time. And you sell back the car for the Bronco for $55,000. So that's $5,000. So you make $65,000 over that 4 year period in this example. With contractual, there's not HOPE involved with it because it's contractual. The only thing you have to be concerned about is that the dealer goes out of business, right? But it's a very strong, big dealer, has multiple dealerships of every kind in this example, right? As we continue the analogy and illustration. And so $65,000 on a $55,000 investment, you get your money back. That's over 100% return on your money in that example. Now, it doesn't always work that way, right? But sometimes it does.
Right. Those are bigger numbers, but it's to illustrate what's possible, right? If that was the scenario, what would you do? You would go around the people who had those contracts, right? Uh-huh. And you'd buy them up from the different people. You buy the Broncos for $48,000, for $50,000, for $52,000. You might even pay $60,000 because you still know you're getting that $15,000 a year, right?
Still a lot of money, right?
And you'd go buy as many of those as you could, especially if they were at discount.
But so why would anybody sell them, Daniel? Why would anybody sell them, especially sell them at the discount if that's what they got going on?
They need liquidity, right? They need some money. They have a property tax bill due, right? They don't have confidence in the dealership. They want to trade up to a Tesla, right? There's all kinds of reasons that somebody might do that. But the point is, this would be a really special deal, right? This would be so everyone wouldn't know about it. That would be another thing. So maybe you're somebody who just knows, right? You got in on a special deal because you were doing your research and you found out that there's just a small percentage of this and you got involved and you start buying them up.
Right. Another big reason why they sell like that is because the people die and their kids don't want the Bronco. They don't want they don't want that stuff, right? So they just want the money. So they're selling it from that. That's another option. So there's lots of reasons why they're sold. But the point is being out there when you do it. We watch all these shows on TV where they're in some form of treasure hunting, right? Like the storage wars and such, right? Where they go and they bid on that, and they can only look at what's in there, and they're trying to guess what's in there, but they're treasure hunting, right? Is what they're doing. They're hoping that there's going to be some good stuff in there, and sometimes they lose out totally in what they invested. Sometimes they make big money because they found something in there. But this is other than, but treasure hunting for deals that have contracts that are either promised or guaranteed is a whole nother deal. And
right. And the key behind that is when you buy those, you know what you're going to earn.
Right.
You know that you pay this, you're going to earn this much percentage. Yeah, now you can always do better than that because they could buy it back from you early and you could do better. People could reprice it and it could shoot up in value. So you still can get that G, you still can get that growth, but you don't have to count on the growth because you know that this company is contractually going to pay you your interest and buy it back from you. You're not hoping that they have good earnings. You're not hoping this. You're not hoping that. You're lending them your money and they have to contractually pay you back.
So really what you're saying is if you want your retirement to be stress-free, invest for the I and not the G. All right, cool. Well, we're going to have to take a break, and you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is your retirement recession-proof? We want to educate you and help you with that. So we have this book, The Most Important Thing. Most important thing for somebody in and close to retirement is to make sure that their retirement, that their money, that their portfolio that is protected from recession and is going to be there for the rest of their life. Howard Marks has written some things that can educate you, help you, inspire you for what you can do to set up your retirement to be recession proof. We'd love to put this in your hand for free to the next 5 callers at 800-725-7616. 800-725-7616. There's operators on hand. Call now, 800-725-7616 for this free book, The Most Important Thing. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
I was talking to somebody the other day. He was telling me how he's going to school in Texas. He decided to go visit some friends in Colorado. And had a Camaro, in Texas. And you know how people are. Everybody thinks they know how to drive in the mountains and drive in snow. You got these pictures of what a mountain is. You've been in the mountains before. It's funny. Not everybody actually knows what Colorado mountains are like, driving up 70 through the mountains. So it's winter time, driving up through Texas, just having a good time, sporting around in this Camaro, driving, going up the mountain, and snowstorms coming in. And he says, no big deal. Like, what's a little puny snowstorm I could do? It's driving up and just starts going sideways, trying to make it up the mountain, just starts going sideways, and keeps trying to push it to get it up. Finally decides, not very far up the mountain, I'm going to turn around and sleep down here and then make it tomorrow. So turns around, goes, gets to a hotel, gets up the next day. It's bright out, starts driving up the mountain, gets to the top, looking over, seeing the view, seeing I would have had to drive down that in the dark, in the snow. I would have died. I am so thankful that I did not make it up the mountain before I got very high so I could turn around. Otherwise, I either would have been sleeping, stuck somewhere in the cold, or just slid off the mountain. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is your retirement recession-proof? And Daniel, wow. That is something. And that's a great example what so many times happens in retirement with people or during their lifetime, going up the mountain of retirement, right? And going up in a two-seater sports car. And it's fun and exciting and everything like that. But when you get near the top, when you get near retirement age, right, you start seeing the snow. You're in the snow. You see the snow. You look over the edge. It's a long way down. It's scary. Why is it scary? Well, because there's change coming, right? When in retirement, you got several things happening. You got your friends are going to change, your schedule's going to change, your paycheck's going to change, a lot of change. You've been doing something for maybe 40 years, give or take, and that's all going to change. And so now you got to, there's a certain piece of apprehension that comes along with that, right? Well, you make it up in your 401k plan, a two-seater sports car, but when you get to the top of that mountain, do you really want to go across that mountain, especially if you're from the South, like Texas, in a two-seater sports car that you don't know how to drive in the snow? Or, would you rather have an all-wheel drive SUV driven by a professional driver that's been there before and knows ins and outs? And you don't have to worry about snow. You don't have to worry about ice. You don't have to worry about black ice because this professional driver knows what he's doing or she's doing, right? And can get you across that mountain safely and to the other side. Wow. And that's what we're talking about today. Is your retirement recession proof? If your retirement's recession proof, you're taking that SUV and you don't have to worry about that ice and snow and black ice. Right, Daniel?
Yeah, exactly. That's protecting yourself, right? In that situation, to have a professional driver who has a car that's ready to drive in those conditions is what we're talking about with the portfolio.
Exactly. Yeah.
Because people always talk about how markets go up and to the right, and they're 100% correct. Markets go up and to the right. Now there are stock markets that have gone to zero, right? Germany's done that a couple of times. The US never has, and I don't expect that the US will. But the difficulty comes in when you're collecting money out of your portfolio instead of putting money into your portfolio.
Yeah.
Everything works in reverse. So when you go through these long flat periods of times or downturns, you either have to stop spending or you have to come up with money to start saving, right?
Right.
And or you're eating up your principal. And so when we go through these long historical periods of time where markets are flat, what do you want to do? Do you want to keep your lifestyle? Do you want to have enough cash on the sidelines to make it through a 10-year flat period? Well, then what are you doing? Like, if you have that much cash on the sidelines, you're not earning anything anyway.
It's sitting on the beach sipping pina coladas, right? And that's not good. We want it in a sweatshop working hard. Daniel, when you talk about, do you stop taking out when the market's going down or the market's going sideways? Well, the problem with that is required minimum distributions. When you're required to take the money out, and you have to take it out even though it's coming down. So right now the market's down and people are taking out their RMDs for last year, the required minimum distributions, and they're selling at a lower rate. It's cannibalizing their assets. Not a good position to be in. And if you're listening to us, you're listening to Financial Strategy with Andrew and Daniel Agemy. Today's topic is your retirement recession proof? Well, one of those ways to make it recession proof is making sure that the allocations are set up properly to be able to give you what you need when you need it and be able to still work for you, even if the stock market's coming down, even if a recession is in place. And so we have these papers we'd like to give to you today. It's called, Are Your Allocations Right for Required Minimum Distributions, for Social Security, this will give you some education so you can make an informed, smart decision, because people don't know what people don't know. And if you're one of those people with, like, a lot of people who are not professionals, even a lot of professionals don't know what they don't know when it's talking about the stuff we're talking about here, well, then it will help you. And, if you're a financial professional listening, hey, call up and ask for it, man. We'd love to educate you. Love to put you in a better position. So have that by calling 800-725-7616, 800-725-7616. Ask for the paper on allocations, and you'll get both of those. Daniel, we just have a few minutes left in this show, man. It's been going fast today. It's been fun, right? And we're looking at this. We're wanting to help people. Are we in a recession or not? Well, it's hard to tell from a lot of angles, but that's not the point. The point is making sure that your portfolio, that your retirement is recession proof, because it can happen. And you've already given us some examples of that. One of the things, that, you had talked about at one point prior to going on the air was the idea of, how we know the ranges that these things are trading in. Like, if we go back to that Bronco story, and the ranges that you can buy those Broncos in, so that if the Bronco goes, to $60,000, to sell it at 60, because you can buy it back later for 50, or that kind of thing. I mean, is that something that, helps people to be recession proof at this point from your perspective?
Yeah. Well, if we contrast it, like a diversified income portfolio that's designed to support your lifestyle compared to a Wall Street model. So a Wall Street model would be, you're in this for the long haul, right?
Yeah.
Wall Street's job is to get you to part with your precious money for as long as possible so they can collect fees, right? Get you in their products. So you're depending usually on mechanical flows. Hey, you listeners out there, mechanical flows. You know what that is? A mechanical flow is when you have automatic purchases going into an index, right? You set up, people use that for savings accounts now, right? Instead of putting money in the bank where you won't earn anything, people have money go into an S&P fund, and that's their savings. Your 401ks go into these funds. Now, the difficulty is when these things are they're not at all-time highs right now, but they're in the 5 percentile of all-time highs, where companies, you're paying 40 times earnings. That means it will take the company 40 years at current cash flows to get you your money back. 40 years. That's a lot of duration, right?
Right.
So
crazy.
As long as those flows keep coming in, then things look well. Now, the managers of these passive funds are price agnostic, right? They're PE agnostic. They don't care if Apple's trading at 40 times earning and it's a $2.5 trillion company. They don't care if there's companies in there that are trading 80 times earnings, right?
Right.
All they're doing is taking their money and following this mandate that the fund has.
They have to.
That's in contrast to what you're talking about, where you're talking about finding something where it's either non-correlated, reverse correlated, and it will pay you. So there's different types of securities that provide different types of income. So some benefit from rising interest rates. So it's like a adjustable mortgage. As rates go up, they pay you more money because they start charging the people they lent your money out to more money, right?
Nice.
And then we talked about the international stuff where when the dollar is getting stronger, maybe they're not performing as well. Yeah. You're still collecting your income, but then if the dollar starts coming down, they grow because the earnings are growing, and they grow because, or your cash flows are larger because you're measuring it in dollars, and so they're bigger.
Right.
With those like preferred securities, that's where there's a lot of opportunities now, because you can buy those things. They're trading at discounts, right? So the company is going to buy it back at $25 a share. Maybe you could buy that for $22 or $21.
Wow, nice.
So you buy that, you collect the income, and then the company buys it back for $25 a share. If rates turn around, right, and rates start coming back down, because, I mean, how much debt does the U.S. government have? $30 trillion. You think rates are going to keep going up with a $30 trillion? I mean, listeners, you think about that yourself. You think they're going to stay high with $30 trillion that they have to pay interest on?
Either they're going to have to bring it down or do a magic show to change everything, change denominations, everything in order to make it happen. It's crazy.
So when you're able to pick up these kinds of deals, if you hold it to maturity, you get par, you collect your income in the meantime, and you get to use that income if you don't want to spend it to reinvest throughout a recessionary environment. And then if things do turn around and rates start going the other way, you get the growth. You always get the income, but you could get the growth, and it will pop back up to par faster. And you get to make the decision, is it time to flip out of this and go, or your manager gets to make that decision, we're going to flip out of this. But the point is, instead of depending on passive flows and mechanical flows, right?
Yeah.
You're looking at contractual guarantees. You're looking at promises. You're looking at things like this where you know what your return will be.
Good. So instead of engineering income, you having true income that's promised or guaranteed to you. Nice. That is beautiful. That's a great way to protect and to position your retirement to be recession proof. Thank you, Daniel, for that stuff. Well, we're come to the close of the show today, and we hate to part with you because we're enjoying this, and I hope you're enjoying listening to us. But financial strategies with Andrew and Daniel Agemy. Today's topic has been, is your retirement recession proof? Well, we want to give you a book, our parting gift today, a book called The Most Important Thing by Howard Marks. And you can have this by calling 800-725-7616. 800-725-7616 to the next 5 callers. If you want your retirement to be stress-free, invest for the I and not the G. We wish you and hope for you to have a stress-free retirement.